In this video, we will explore about violations and penalties in the trading and clearing process. When you participate in the financial markets, there is a strict set of rules, bylaws, and regulations that everyone must follow. If a clearing member or a trading member fails to comply with any of these provisions, it is officially treated as a violation. And as you might expect, these violations are taken very seriously and will attract appropriate disciplinary actions, which naturally includes severe financial penalties. Moving to the specific types of compliance lapses, let us first look at failures related to fulfilling obligations. One major violation is the non-fulfillment of initial margin obligations, which means a member did not deposit the required upfront money to cover their trading risks. Another serious lapse is the non-fulfillment of settlement obligations, where a member fails to pay the required funds on the settlement day. Similarly, there is the non-fulfillment of securities deliverable obligations, which happens when a member fails to actually deliver the required shares. Finally, falling short of the required safety net, known as the non-fulfillment of minimum deposit requirements, is also categorized as a strict violation. Building on that, there are other crucial boundaries that members must never cross, which we can think of as the three pillars of risk limits. First is the exposure margin violation, which happens when a member takes on too much additional risk without the proper financial backing. Then we have the position limit violation, which occurs when an individual or a trading member holds more active derivative contracts than they are legally allowed to. And the third major breach is the market-wide position limit violation, which is triggered when the total open interest for a specific stock across the entire market exceeds the legally permitted threshold. There are also a few specific operational and reporting warnings that the system watches out for very carefully. A massive red flag is the misutilization of collaterals and deposits belonging to trading members, constituents, or clients. Using someone else's safety money for your own purposes is a severe violation. Next is the violation of exercised positions, which relates to not honoring the outcomes of options contracts when they expire. Furthermore, there is a strict penalty for the short reporting or non-reporting of client margins. If a broker collects the right margin from you but fails to accurately report it back to the clearing corporation, they will face serious trouble. So, what exactly happens when a member actually commits one of these violations? The consequences are swift and severe. In the event of a violation, the clearing corporation has the power to step in immediately. They can advise the stock exchanges to completely withdraw any or all of the membership rights of the offending clearing member, and they can do this without giving any prior notice. This drastic step doesn't just affect the clearing member. It includes the complete withdrawal of trading facilities for all the trading members connected to them, as well as stopping the clearing facilities of any custodial participants relying on that specific clearing member. Along with losing their trading rights, the violating members also lose control of their current market positions. To protect the broader market from further risk, the exchange will forcefully step in and close out all the outstanding positions of that specific clearing member. This also applies to any trading members who clear and settle their trades through that penalized clearing member. It is very important to understand that this forced closure is absolute. The action taken by the exchange to square off these positions shall be final and completely binding on both the clearing member and the trading member. Finally, to fully recover any potential financial losses, the clearing corporation is equipped with a powerful toolkit of additional measures. They can start by directly imposing heavy financial penalties on the violator. If that is not enough, they can enforce the collection of appropriate additional deposits. To physically get the cash needed to settle the market, they have the right to realize money by directly disposing of or selling the securities held in the member's account. And lastly, they can immediately invoke and cash out the member's bank guarantees or fixed deposit receipts, All of these tools ensure the market remains completely secure and stable even when a single member fails.